Money talks. This old saying emphasizes the truth that those who control money achieve success and profit. In the Forex market, this is not just a phrase, it is the foundation of every profitable decision. By understanding the economic and political factors shaping the value of the euro, investors can seize significant profit opportunities and turn market fluctuations into a consistent source of income. So, will you be the one managing how money is made, or will you let others dictate the rhythm of your financial future? Learn the forces behind the euro and secure your path to greater earnings. One of the most significant forces shaping the value of the euro is the policies of the European Central Bank, ECB. Through tools such as interest rates, asset purchase programs, and inflation targeting, the ECB directly influences the supply-demand balance in the market, creating both risks and opportunities for traders. Hawkish policies refer to measures such as raising interest rates or implementing monetary tightening. These policies make investments more attractive for investors, increasing demand for the euro and leading to its appreciation. For example, during periods when the ECB raises interest rates to control inflation, the euro strengthens in international markets. Hawkish actions also create a sense of security against market volatility, encouraging investors to turn to euro-based assets. With such strategies, traders can enhance their profit potential. Dovish policies encompass stimulative measures such as interest rate cuts or the expansion of asset purchase programs. These policies encourage borrowing and spending to support economic growth, but can lead to a depreciation of the euro by increasing its supply. Typically implemented during periods of economic slowdown, these policies promote short-term growth but may weaken the euro's international appeal. Macroeconomic indicators are among the primary factors shaping market perceptions of the euro's value. These indicators reveal the economic health of the eurozone, providing critical signals for traders. High economic growth rates boost investor confidence, leading to an appreciation of the euro. During periods of economic expansion in the eurozone, the economy's robustness attracts investors and increases demand for the currency. Conversely, low growth rates can negatively impact the euro's value. Rising consumer confidence supports perceptions of economic stability and increases demand for the euro. Specifically, an increase in the Consumer Confidence Index indicates that households are more willing to spend, creating a positive effect on the markets. On the other hand, a decline in confidence signals economic uncertainty, putting downward pressure on the euro's value. Retail sales reflect trends in consumer spending, while industrial production indicates the level of manufacturing activity. Positive trends in both indicators are viewed as signs of economic revival, contributing to the euro's appreciation. However, declines in these indicators strengthen perceptions of economic stagnation, negatively affecting the currency. The Eurozone's trade balance and current account status are key economic indicators that directly shape the euro's supply-demand dynamics. While the trade balance reflects the difference between exports and imports, the current account goes beyond trade to include services, income flows, and transfer payments. If the Eurozone exports more than it imports, it creates a trade surplus. A trade surplus increases demand for the euro because foreign buyers must use the euro to purchase goods and services from the Eurozone. For example, Germany's strong export-oriented economy positively contributes to the Eurozone's trade balance. Such a surplus showcases the region's competitiveness, boosts investor confidence, and supports the appreciation of the euro. The current account is a broader measure that includes trade, interest income, and transfers. A current account deficit indicates that the Eurozone is borrowing from or importing capital from the rest of the world. This can raise perceptions of economic vulnerability and put downward pressure on the euro's value. When imports consistently exceed exports, demand for the euro decreases, weakening the currency. The Eurozone is an economy heavily reliant on energy imports, making it highly sensitive to changes in the prices of energy commodities such as oil and natural gas. Fluctuations in energy prices not only affect costs, but also influence key indicators like the trade balance, inflation, and economic growth, playing a decisive role in the value of the euro. Rising oil and natural gas prices increase the Eurozone's import costs, widening the trade deficit. When imports exceed exports, the trade balance deteriorates, reducing demand for the euro. Additionally, high energy costs shrink consumers' disposable income and slow economic growth. Geopolitical events like the Russia-Ukraine conflict further threaten energy supply, driving up prices and weakening the euro's value. Falling energy prices lower import costs, narrowing the trade deficit and improving the current account. Reduced energy costs ease inflationary pressures, boost consumer spending, and support economic growth. This strengthens confidence in the euro and creates a positive market sentiment by improving the profitability of energy-intensive sectors. Investor behavior in global markets is shaped by two fundamental periods: risk on and risk off. These periods directly influence the value of currencies like the euro. During risk-on periods, when risk appetite is high, investors are drawn to assets like the euro that offer higher return potential. Conversely, in times of uncertainty or crises, risk-off behavior leads investors to prefer safe haven assets such as the US dollar or Japanese yen, which puts downward pressure on the euro. During periods of global economic growth, when central banks adopt expansionary policies and geopolitical risks are low, markets tend to adopt a positive outlook. In this optimistic environment, investors gravitate towards riskier assets like the euro, driving up its value. For example, during times when global growth expectations strengthen, the euro often becomes a favored asset and appreciates in value. In times of uncertainty, investors prioritize low-risk assets. Geopolitical tensions, economic stagnation, or financial crises increase demand for assets like the US dollar or gold, reducing demand for the euro. For instance, during major crises such as the COVID-19 pandemic, investors moved away from the euro in favor of safe haven assets, which suppressed the currency's value. The value of the euro is not solely influenced by economic developments within the eurozone. Policies of major central banks, such as the US Federal Reserve and the euro's relationships with other global currencies, play a decisive role. These factors are particularly strategic for Forex traders. The euro and the US dollar EUR-USD pair is the most traded currency pair in the Forex market. During periods of dollar strength, investors tend to favor the dollar, putting pressure on the euro. Factors such as Federal Reserve interest rate hikes or strong US economic data can enhance the dollar's appeal. Conversely, during times of dollar weakness, the euro appreciates, becoming more attractive to investors. Due to its trade connections, the euro is also linked to the currencies of emerging market economies. Economic fluctuations in countries like Turkey, South Africa, or Brazil can indirectly impact the euro. For instance, economic troubles in one of these countries may affect exports from the eurozone, weakening the euro's value. Success in the markets comes from a deep understanding of the factors influencing the euro's value. Traders who closely monitor economic indicators, central bank policies, and geopolitical events can prepare for market fluctuations and turn these changes into strategic profits. Interpreting factors such as energy prices, trade balance, and global risk perception, key drivers of the euro's rise or fall, not only boosts trading confidence, but also supports long-term success. Traders who act with this awareness can anticipate market trends and take more profitable positions.